Hello guys, in this video we will learn about value investing. Value investing written by Benjamin Graham. Benjamin Graham was a British-born American economist, professor and investor. He is widely known as the father of value investing, and wrote two of the founding texts in neoclassical investing, Security Analysis with David Dodd, and The Intelligent Investor. Value investing is an investment strategy that was popularized and championed by Benjamin Graham and later refined by his student, Warren Buffett. Warren Buffett, one of the most successful value investors of all time, has famously adhered to these principles throughout his career. Warren Edward Buffett is an American business magnate, investor, and philanthropist. He is currently the chairman and CEO of Berkshire Hathaway. As a result of his immense investment success, Buffett is one of the best-known fundamental investors in the world. Value investing is a disciplined and time-tested strategy, but it requires thorough research, analysis, and a clear understanding of the assets being invested in. As with any investment approach, there are risks involved, and not all value investments will necessarily perform well. The strategy involves identifying and investing in undervalued assets, such as stocks, bonds, or other securities, that are trading at prices lower than their intrinsic value. 7 key principles of value investing includes 1. Intrinsic value 2. Margin safety 3. Long-term perspective 4. Fundamental analysis 5. Contrarian approach 6. Diversification 7. Avoiding speculation. Let's start with intrinsic value first. Intrinsic value? Intrinsic value, in the context of investing, refers to the perceived true or fundamental value of an asset, such as a stock, bond, or business. It represents the estimated worth of the asset based on its underlying characteristics, earnings potential, cash flows, and other fundamental factors, regardless of its current market price. The concept of intrinsic value is an essential aspect of value investing, a strategy that focuses on identifying undervalued assets and investing in them with a margin of safety. Value investors believe that the market may misprice assets in the short term due to various factors, such as market sentiment, speculation, or macroeconomic conditions. Thus, they aim to buy assets whose intrinsic value exceeds their market price, offering a potential for long-term appreciation. Margin of safety. The margin of safety is a fundamental concept in investing, especially in the context of value investing. It refers to the difference between the intrinsic value of an asset and its current market price. In other words, it is the gap between what an investor believes an asset is worth and the price at which it can be purchased in the market. The margin of safety provides a buffer or cushion against errors in estimating the intrinsic value and unforeseen negative events that could affect the asset's value. By buying an asset at a price significantly below its estimated intrinsic value, an investor increases the probability of potential gains while reducing the downside risk. For example, suppose an investor calculates the intrinsic value of a stock to be $50 per share using various valuation methods. However, the stock is currently trading at $30 per share in the market. In this scenario, the margin of safety is $20 per share. $50 30 equals $20. By buying the stock at $30, The investor has a $20 buffer in case their valuation is slightly off or if the market becomes unfavorable. 3. Long-term perspective. Having a long-term perspective is a crucial aspect of successful investing. It refers to an investment approach that focuses on holding assets for an extended period, typically years or even decades, rather than attempting to profit from short-term price fluctuations. Investors with a long-term perspective are often referred to as buy and hold investors. Fundamental analysis. Fundamental analysis is a method of evaluating investments, typically stocks and bonds, by analyzing the underlying financial and economic factors that could influence their value. The goal of fundamental analysis is to determine whether an asset is overvalued, undervalued, or fairly priced, based on its intrinsic value. Contrarian approach. The contrarian approach is an investment strategy that involves going against the prevailing market sentiment and making investment decisions that are opposite to the current market trend. Contrarian investors believe that the market often overreacts to news and events, causing asset prices to deviate from their intrinsic value. They aim to capitalize on these market inefficiencies by buying assets that are currently out of favor or selling at a discount. Diversification. Diversification is an investment strategy that involves spreading your investments across a variety of different assets, industries, or geographic regions. The goal of diversification is to reduce the overall risk of your investment portfolio while potentially increasing the likelihood of positive returns. It is a fundamental principle in modern portfolio management. Avoiding speculation. Avoiding speculation is an important principle in prudent investing and financial management. Speculation involves making high-risk investments or trading decisions based on short-term price movements, market rumors, or emotions rather than on fundamental analysis or a long-term investment thesis. Speculators often seek quick profits and are willing to take on significant risks, hoping to capitalize on short-term fluctuations in asset prices. 8. Emphasis on quality. Emphasizing quality is a core principle in successful investing, particularly in value investing and long-term wealth building. Quality refers to the underlying strength and stability of an investment, be it a company's stock, a bond, or any other asset. Investors who prioritize quality seek assets with strong fundamentals and positive attributes that are likely to contribute to long-term growth and stability.